A very good evening to everybody. Welcome to the webinar on the crypto landscape after the 2022 price declines. I'm Ming Hui from Phillip Nova, and speaking to us tonight will be Mr. Tariq Dennison. He is a multinational wealth manager and founder of GFM Asset Management. And tonight he will be discussing with us the basics of Bitcoin and Ethereum, what drives the value, as well as the various investment vehicles available. Before I pass this on to Tariq, please be reminded that if you have any questions throughout the course of the webinar, you can drop them into the questions box and we will address them during the live Q&A session towards the end. And now without further ado, let's have Tariq speak to us.
Excellent. Thank you very much for that kind introduction, Minghui, and good evening, everybody. Thank you for taking some time out of your evening to join our crypto market landscape. Just to test that all of you can see and type into the questions pane, please do find it on your left-hand side. If you can go there and just type a quick hi, hello, why, question mark, anything there to let me know that you can see it and that we can go ahead and receive those questions. That way Minghui or I will know that you can hear us, you can ask questions, and we will be doing the Q&A all at the end. For the title slide, if you've seen any of my presentations, you know I take quite a bit of time in thinking about a good cover picture for whatever I'm going to present. And this one is a stock image, but I think it does show not just the ups and downs of the digital landscape, but it does show it is in fact a multi-dimensional landscape. My goal today is really to help you explore both the Bitcoin and Ethereum ecosystems, have a much, much better understanding of what gives them value and really how to develop your own strategy towards these two cryptocurrencies and where they fit into your digital asset portfolio. So before we get into it, a very important disclaimer from me and my firm. And a little bit about me in case you've never heard of me before and I've never heard one of my presentations before. As Minghui said, my name is Tariq Dennison. I'm a trust and estate practitioner and independent wealth manager with two, and actually in the process, a third fully regulated wealth management firm, one in the US, one in Hong Kong, and I'm in the process of setting one up in Switzerland. I've been in the market since 1998, so next year I'll celebrate 25 years of market experience, but I think it'll show you by the names of these firms. I'm very much in the world of traditional finance, so traditional stocks and bonds, and I really come at cryptocurrencies from an economic and financial point of view more than from a technical point of view. That said, I am quite technical, as you can guess from my degree in Master's in Financial Engineering from the University of California at Berkeley, and I still do teach two Master's in Finance courses at ESSEC Business School in Singapore, which I'm hoping to come back to in person in the spring. So if you're down in Singapore at that time, please do write, and I'll see if we can meet for a coffee at that time. I often try to come with a one-liner to try and summarize my point of view or how I differ from other investment advisors. And my current tagline is neither standard nor poor, really summarizing that I am a very, very strong critic of the S&P 500 and other Standard & Poor's indices. I'm very much a one for thinking outside of the box, going against convention, and coming up with non-consensus investment ideas. And that's what I'm really here to talk to you about and try to give you a perspective on Bitcoin and Ether that you might not be hearing from a lot of other places, that hopefully you'll find much, much more useful. If you'd like to read my book, my first book published in 2018 is titled Invest Outside the Box, Understanding Different Asset Classes and Strategies. Chapter 9 is on cryptocurrencies, and much of it I think is still quite relevant, although it deserves to be updated. My next book I think is going to be due out next year. I'm still in the process of writing it, and it'll have quite a bit about crypto as well. But that's further reading if you'd like to know more of my perspectives on crypto. So what are we going to be talking about today? As Minghui mentioned, I'm going to be talking about Bitcoin and Ethereum, more specifically about Ether, the cryptocurrency on Ethereum. I'm going to be explaining really in very fundamental terms what Bitcoin is. So apologies to those of you who are Bitcoin experts. I know that in audiences like these, we get brand new users of Bitcoin who are very new to Bitcoin and want to start with questions like, what is Bitcoin? What gives Bitcoin value? Why is Bitcoin so volatile? So I'll be spending quite a bit of time on that, though possibly explaining it in a way that even Bitcoin veterans may not have heard quite as clearly as before. So I'm going to be talking about things like proof of work, mining, halving times, all on the supply side. And then I'm going to be talking about the demand side. Both of these together should give you a good fundamental picture of what drives the price of Bitcoin up and down. Of course, I'm expecting this is where I'm going to be getting a lot of questions in the Q&A, but that's what we're going to be talking about as far as Bitcoin. Then when I talk about Ethereum and Ether, I'm really going to be talking about how they're so different than Bitcoin. So the analogy I'm going to use is that Bitcoin is often compared to gold, while Ether can be compared a lot more to crude oil or to natural gas in terms of what its source of value is. So unlike Bitcoin, where its fundamental value comes from being scarce, comes from there being by definition only 21 million Bitcoin, Ether has value because it's used to pay for smart contract execution. And what does that mean? What is this ecosystem of smart contracts? That's what I'm going to be spending more time on when I talk about Ether and Ethereum. Now, I can't talk about Ethereum without talking about the transition to Ethereum 2.0, proof of stake, and how significant that is for really everything having to do with Ether and Ethereum. I'm going to try my best to summarize as best as I can in the fraction of this 1 hour presentation that we have. So sit back and try your best to absorb all of this. Now, that's just the first half of the presentation, talking about what Bitcoin and Ether are. I'm guessing most of you are here not just to learn the fundamentals of Bitcoin and Ether, but really to find out how to make money. And where I will say you are quite lucky, this is going to be one of the few presentations where I actually present the closest thing possible to a free money trade. I'm hoping that gets some of your attention because it really isn't that often that I really present what I think is a fairly easy way to make money, obviously with some risk, but I do want to present to you what is the difference between trading these cryptocurrencies on the spot market versus using futures contracts and how you can use them together to, as I say, get as close as you can find in the markets to what you might call free money. So I'm going to be talking about the spot markets, and I'm going to be talking about the futures markets in both Bitcoin and Ether. Specifically in futures, I'm going to be talking about micro Bitcoin futures and micro Ether futures. I must apologize that I've left the bullet point for micro options on there. I'm not going to be talking about the options today, but if you are interested on reading more, that is on the same CME website if you'd like to read about that. As with everything, I do like to use examples. So I will be showing you some sample trades using both micro Bitcoin futures and micro Ether futures and presenting really quite specifically that what I call close to free money trade as you can get at the very end. So please stay tuned all the way to the very end because that's where I hope to present these. So first of all, why are we talking only about these two cryptocurrencies? There's so many cryptos out there. Why just Bitcoin and Ether? Well, quite obviously, they are the two biggest and most widely used cryptocurrencies. As you can see, this screenshot is already very, very old, not even a month old, but already quite ancient when you consider this was back when Bitcoin was $30,000 a Bitcoin, Ethereum was almost $1,800 a Bitcoin. Both of those have fallen by over 30% in just the past 2 or 3 weeks. But what still remains true is that Bitcoin is by far the #1 cryptocurrency by market cap, by overall market value, and Ether is #2. And all these other ones here are really to just give you a picture of what the remaining top 12 are. And I've gone to top 12 rather than just top 10 because I want to show you wrapped Bitcoin and where that fits in there. Wrapped Bitcoin is basically Bitcoin wrapped in an Ethereum token so that it can be traded and used on Ethereum dexes and Ethereum lending platforms, as I'll be alluding to a little bit later on. But basically, again, Bitcoin and Ether, the top two. Just so that you know, #3 and #4, Tether and USD coin are both what are called stable coins. So the reason that you see their prices very, very close to $1 is because that is by design. They are designed to always trade right around $1, as is Binance USD, which is #8. Those are called stable coins, and those are usually used for trading against either Bitcoin or Ether on the major exchanges in cases where you don't want to have to worry about moving actual dollars around to and from a bank account. We could go into a summary on what all these other cryptocurrencies are, but really those deserve their place in another presentation. For now, just know that Bitcoin and Ether are by far the biggest two, and stable coins occupy slots number 3 and 4. Let's start with talking about Bitcoin. So Bitcoin is the one that you've probably heard talked about by far the most. In fact, to many of you, when you think of crypto, you're probably thinking of Bitcoin and only Bitcoin. There are several places where Bitcoin is really the start and end. So let's make sure we understand Bitcoin, because really to understand any crypto, I think you need to understand Bitcoin first. I'm going to start with what is the first and most obvious question, and one which I unfortunately think is still hard to get a really good answer on from most places, and that is, what is Bitcoin? For my answer here, I've provided a link at the bottom to a YouTube video that if you have not seen, I highly, highly, highly recommend seeing. It is by a math education channel called 3 Blue 1 Brown, and in my view, it is by far the best and cleanest explanation of what Bitcoin actually is and how the Bitcoin network works. The next few slides are really my best summary of most of the details that he covers in that video. And dare I say, most of the other YouTube videos you're going to find on Bitcoin, in my view, are really quite, junky and very low quality. This is one of the few very high quality ones, because it explains that a Bitcoin is really nothing more than an entry on a decentralized ledger. In other words, to own a Bitcoin is to have copies of a ledger kept on many, many computers around the world simply say that your address owns a Bitcoin. So what do I mean by an address? Well, take, for example, your email address. If I have your email address, I can send you an email. Anyone in the world with your email address can send you an email. But only with your password do you have the ability to send someone else an email from your email address. The idea behind Bitcoin is more or less the same thing. The idea is only with your private keys can you send someone else a Bitcoin, but anyone with your Bitcoin address can receive a Bitcoin. Now, who keeps track of this ledger? That was the main problem solved in the Satoshi Nakamoto paper. How do you have decentralized consensus? Well, basically, you have a ledger that everybody maintains a copy of, and we're all competing to maintain the most recent copy of this ledger. And the way that you know that the ledger is honest and accurate is that every previous transaction, every previous block, as it is called, needs to show the signature of the block before it and all the transactions. So take, for example, here, I'm showing an example of 3 blocks. So in the first block, you see 2 transactions. Alice pays Charlie, Charlie pays you. That is in one block, and it contains the hash of the previous block and a proof of work showing that that block is in fact valid. Now, the hash of that block needs to be included in the second block, the block where Bob pays Alice and Alice pays Bob. If anything is altered in that first block, so for example, if it says Alice pays Charlie only 40 LD or 30 LD instead of 50, or Alice pays Bob instead of Alice pays Charlie, it will change all of the hashes in all the subsequent blocks and basically render them invalid. And I'll know that that copy of the ledger is fake, and only the one where all of the hashes match and all of the proof of work shows me the longest chain, that is the valid block. This is what we mean when we say a block chain. So basically, every block contains a list of transactions, but it also contains a cryptographic signature showing that it is consistent with the block right before it and the block right and the block right after it. The proof of work is basically what is there in place to show that whoever has verified that block has put in enough computing power that it's not a fraud, that it's not something that's easy to fake. What is the equivalent of proof of work in the traditional finance world? I often say it's the capital required to get a banking license and build the building for a bank branch and put your name out on a regulator. It's the same sort of thing where basically, if I trust that a JP Morgan or an HSBC or a Maybank will keep the ledger of me paying you $10, I trust Maybank because Maybank has put up effectively that proof of work or proof of stake showing that they're not just some dodgy fly-by-night bank. They've put all the effort into becoming who they are, and we can trust them. The problem is it's a centralized ledger, and here we're looking for a solution that allows this ledger to be maintained on a decentralized network, if that makes sense. That was my best attempt to try and summarize that in a few minutes. What do I mean by trusting the network that has the most, or the blockchain that has the most work in it? As I mentioned, the YouTube video that I showed you the link to has a much better description that I'll be able to provide in a few minutes. But imagine that we are all maintaining a ledger. Maintaining a ledger where Alice pays Bob, Bob pays Charlie, Charlie pays Deborah, and so forth like that. And there's ever a disagreement between two copies in the ledger. The protocol in the Bitcoin world is that you accept whichever copy of the blockchain is the longest. And by definition, the one that is the longest is the one that has the most work put into it, work in the sense of most computing power. The idea, just like having a bank with $1 billion of capital or a bank with big, expensive marble bank branches, is that this long ledger is very, very hard to fake. The only way that you can create and maintain a fraudulent blockchain is if you can, time after time after time, create the proof of work faster than all of the other computers on the network. And as you've probably heard, the Bitcoin mining right now currently uses more electricity than many small countries. So unless you have the computing power of several small countries, you are not going to be able to maintain a proof of work blockchain longer than the rest of the Bitcoin network can. So the one that I've drawn with a smiley face on it is the longest existing blockchain, the one with the most work built into it, and so the one that we're all going to trust because it's the one that everyone's put the most computing power into. That's what we mean when we talk about Bitcoin mining and really proof of work, basically how having the chain with the most work put into it, even though each block was presumably worked by a different computer who guessed the right proof of work. That's how it's maintained on a decentralized fashion. Once again, I've tried my best to explain it in a few seconds. The YouTube video explains it a little bit better. But the reason I'm spending time on this is I want to explain the connection between computing power and the value of Bitcoin, and why Bitcoin has gone up over time as the amount of computing power required has increased. Now, when we talk about mining, you may hear about Bitcoin miners doing Bitcoin mining for profit. In other words, setting up lots and lots of computers, and those computers mine Bitcoin, and those miners get Bitcoin as a reward. Basically, the source of all Bitcoin are these miners. And the example provided here is that when a block is mined, so basically different computers around the world are competing to add a block to the blockchain. The requirements in the Bitcoin protocol is that you need to include the previous hash, then you include all the transactions that are going to be included in that block. Then you can also include in that block a special type of transaction where you basically say, I, the miner, get a reward of, say, 1 Bitcoin or 6.5 Bitcoin. In this case, it just says 10 LD as an example. Now, when all of those transactions are put together in a block, you need to add it with something called the proof of work. Now here, just in the example, it's that number in green down at the bottom. The requirement is that basically when all of these are hashed together through a hash algorithm called SHA-256, that the resulting signature starts with a certain number of zeros. That sounds like a simple enough math problem, but it's actually very, very difficult to fake. And this is where you hear about things like terahashes and petahashes, because basically what Bitcoin miners are doing is they are all trying as quickly as possible to guess that number at the bottom, such that when they hash all of these transactions and the previous hash together, they get that signature that starts with the required number of zeros. So if you look at how do Bitcoin miners earn money, they earn money by being the first one to create the block that lets them reward themselves that certain number of Bitcoin. And that certain number of Bitcoin, the mining reward, is what changes over time and is what limits the supply of Bitcoin. I know, again, that was a mouthful, but stick with me. I'm going to show it to you in charts. So what you may often hear is what gives Bitcoin value is that unlike US dollars or unlike yen, and like any fiat currency, the supply of Bitcoin is limited by design. In other words, written into the Bitcoin algorithm, written into the code, there will never be more than 21 million Bitcoin. Now, if you look at the previous coin market cap slide, which showed the number of Bitcoin outstanding, you'll see that that number is only about 19.7 million right now. There still aren't 21 million Bitcoin outstanding. And that's because the number of Bitcoin outstanding is released in 10-minute blocks in these mining rewards. So initially, the first few Bitcoin were all created in mining rewards, and now they are simply exchanged around, mostly by Bitcoin transactions, and then the miners continue to receive rewards, but the reward from Bitcoin mining gets cut in half over time. And I'm going to show you a little bit about that halving schedule and what that means for the cost of Bitcoin mining and why many see that as a driver for Bitcoin rising in value over time. So what this chart is here to show you is the rise in Bitcoin supply over time by design because of those halving times. And I'm sure I'll get some questions about the halving times, but that is important. Please make sure you understand that. What is that Bitcoin supply chart often compared to? If you compare it to, say, the supply of US dollars or the supply of any other fiat currency, many people see a chart like this and they say, well, heck, if I have something that's guaranteed by design to be limited at 20 million versus something like the US dollar where there's a pandemic and suddenly a lot more get printed and my dollars can get inflated away, certainly isn't there value for having something which is limited in supply. Even if you compare Bitcoin to something like gold, I often say one of the biggest risks to holders of gold is if a meteor suddenly appeared, near the Earth, and suddenly we take a spaceship there and discover there's 10 times as much gold on that meteor than there is in Earth. Suddenly the world gets flooded with gold and the value of gold won't be as much as when there was less gold. Bitcoin, at least, you are guaranteed that there will never be more than 21 Bitcoin, but you are never guaranteed that Bitcoin will be the only cryptocurrency that people pay attention to. I've shown you there are many, many other cryptocurrencies, and so on the demand side, you have to look at how much will people want those 21 million Bitcoins of fixed supply. So many, many different angles here, but compare the supply of Bitcoin with the supply of dollars, and you'll see why many people find Bitcoin attractive. So earlier I talked about halving times. Halving times are basically, predictable times when we already know that the Bitcoin mining reward is going to be reduced. Now, these halving times are by design done at certain blocks, and they are roughly expected to happen around certain dates, but the exact date, of course, depends on how quickly each of these blocks are mined. The first Bitcoin halving occurred on November 28th, 2012 at block number 210,000. So the diagram I showed you earlier of a blockchain, one block right after the other with the hash and the signature and the proof of work, the 210,000th such block was the last one to receive a mining reward of 25 Bitcoins. So basically over that period, 5.25 million Bitcoins were mined. And then the subsequent halving, the one in 2016, reduced the mining reward again from 25 down to 12.5 and so forth. So you can see at each of these halving periods, the reward for mining Bitcoin is reduced, but the cost of actually mining a Bitcoin, the amount of computing power required, actually increases. The reason is the amount of computing power required to mine a block is by design adjusted in proportion to the number of computers attached to the network. So the more computing power there is on the network, the harder that hash will be, so that each block will be mined roughly every 10 minutes. So imagine this from the miner's point of view. If you have to put in a lot more work, you need to burn a lot more electricity to try and mine one block, and you're going to get paid less for that one block, it means the value of that one Bitcoin or the cost of producing that one Bitcoin is going to be much, much higher after every halving. So that's a very, very important concept to understand on the supply side of Bitcoin. It doesn't necessarily affect the demand side, but those are the two sides you need to balance if you're going to come up with a forecast of Bitcoin prices. So the last slide showed you the past few halvings. This one shows you later down the exact same website, whose link I've provided below, giving you forecasts of the next expected halvings, one in 2024, 2028, 2032, where the block reward is expected to be reduced to 3 1/8, 1 1/16, and so forth. You can see how even by 2032, over 99% of the Bitcoin is expected to be mined by that point, and the mining reward is expected to keep declining until the year 2140. After that point, it is expected that transaction fees, basically small fees that you include in a Bitcoin transaction, are going to be the primary ways that miners would get compensated. But Until then, mining rewards and mining costs are going to be a major driver in the value of Bitcoin, at least from the supply side. When you talk about the supply and how mining costs often will put a floor under the cost of Bitcoin, I usually think of charts like this one. And this was one chart that comes from a site called Cointelegraph. In the pink band below, you see an estimate of what the mining costs are, and then that bar, the candlestick chart above it, is the cost of Bitcoin at that time. Now you see there have been a few times, one at the beginning of 2019, the other in kind of around 2020. Those have been times that the price of Bitcoin has actually fallen within or even below the upper end of the range of what it's cost to mine a Bitcoin. That's what here it calls the miner capitulations dump. In other words, why on earth would anybody sell a Bitcoin below the cost of what it costs to mining it? Well, arguably, it's the exact same thing from a gold miner's point of view. If it costs you $2,000 an ounce to take an ounce of gold out of the ground, but the price of gold is only $1,700, would you sell it because $1,700 is better than nothing, or would you hold on to it hoping that the price goes up over time? Clearly, that depends on what your market view is, your economics are, and so forth. But this is one chart that you can look at least from a supply point of view. Then you have to match it against the demand to say what is the miner production cost. So you can see here, at least according to this line from earlier this year, it had projected the current miner production cost was $34,000 per Bitcoin. That means that the current price is well below that range or well under that range. Something worth keeping in mind, again, if you want to look at cost of production versus demand. Going a little bit further into the blockchain, there is the nice thing about cryptocurrencies is that unlike US dollar transactions, everything is out in the open. You can go look at the whole blockchain using all sorts of different tools, see exactly how many transactions are in every block, how much is currently being paid for transaction fees and so forth like that. And this is just another website you can go to for some of these statistics. So this is from a website called bitinfocharts/Bitcoin, and there's bitinfocharts for other blockchains as well, showing you statistics like how many Bitcoins are actually getting sent around, how many on-chain transactions are there, how much is being paid in transaction fees, what's the current hash rate required in order to mine a block, what's the relative level of difficulty. These are all things which I even admit I don't fully understand, but if you look down at things like wealth distribution, number of addresses richer than a certain threshold, those are numbers that I would look at from an economic point of view to give me an idea of the Bitcoin economy, how distributed it is. If I'm buying a Bitcoin, roughly who am I going to be buying it from? What volume of a market am I going to be entering into, and so forth. These are all statistics that are worth understanding, just like when you look at a stock or any other financial instruments. You're going to look at things like what's the price to earnings ratio, what is the volume, what is the number of analysts covering it, and so forth. So this is another site you can look at to try and get some fundamental statistics. Now, earlier I was talking about blocks, and I showed you, for example, block number 210,000 and 420,000. This was a snapshot of some of the block transactions that occurred on June 10th, 2022. So again, I went to Bitinfo Charts, I just went to the Bitinfo Explorer, and I said, just show me the most recent blocks, and it just showed me the number of Bitcoin transacted in that given block, that the Bitcoin reward was 6.25 Bitcoin. It showed me what the timestamp was, showing how, roughly they're usually about every 10 minutes, sometimes a little closer, sometimes a little farther. Again, this just is meant to give you an idea of how transparent, how much data there is on the transactions occurring on the blockchain. I'll leave that with you, and we can move on to Ether and Ethereum. Now, you're going to hear me using the term Ether. Ether is the cryptocurrency, is the actual coin. When you talk about Ethereum, at least for me, Ethereum refers to the ecosystem. It refers to the network where I'm actually able to create smart contracts using the programming language Solidity and have them executed on the Ethereum blockchain. And then I pay for those executions, I pay for those transactions with Ether. I'm including this page also from Bitinfo Charts, but /Ethereum, to show you how those statistics that I showed you last time for Bitcoin compare roughly with statistics for Ether. Now, the first thing that should pop out at you here, and certainly pops out to me, is that the transaction fees are significantly higher, at least as a percentage of transaction volume, roughly 4% instead of 1%. And this is what you'll often hear about when you talk about high gas fees, or how much people are paying in order to execute transactions on the Ethereum network versus on the Bitcoin network. Now, a lot of the reason for that is because the transactions that occur on the Ethereum network can be much richer and much more complicated. Unlike Bitcoin, whose sole purpose is to transfer value. So let's say, for example, I can transfer a Bitcoin to Minghui, and Minghui can transfer a Bitcoin back to me to split a restaurant bill or to pay for apartment rent or whatever. On Ethereum, I don't just have the opportunity to send you Ether to send you value, but I can, for example, place a bet with you on a prediction market about who is going to win the next US presidential election, or who's going to win the Super Bowl, or who's going to win the World Cup. Those are on the prediction markets called Augur or Polymarket or Omen. And the way that those would work is, let's say, for example, we set up a smart contract on Augur where if one team wins the World Cup, I get paid in Ether, and if other team wins, you get paid in Ether, and that gets executed automatically on the Augur platform using a smart contract that neither you or I can control once it's there on the blockchain. And we pay a small gas fee to execute that. So that's obviously smarter and more advanced than simply transferring value unconditionally. There are, of course, several other applications that we can also design on the Ethereum ecosystem. So if you go, say, down towards the bottom where it says exchanges and liquidity, you'll see all sorts of things like Uniswap and IDEX. Those are ways of exchanging Ether for other tokens, like, let's say, for example, DAI or USDC, without going through any middleman. All of the exchanges there happen on smart contracts that are programmed in the decentralized world and executed directly on the blockchain. On the upper right and center, you'll also see credit and lending. You'll see names like Compound and Aave, which I'm going to mention a little bit later. That is a way for me to lend out Ether, or to lend out USDC, or lend out DAI in exchange for interest. And that lending and collateral is all handled on the blockchain in a decentralized fashion using smart contracts. So to rehash, what is a smart contract? A smart contract is basically a piece of software code that can run on the blockchain in a decentralized fashion in a way that no one can control it. And basically the two parties transacting on it pay the gas fee and can exchange there without knowing each other and without having to trust any middleman. That's where a lot of people are getting excited about this concept you sometimes hear called Web 3.0, that rather than relying on, say, Amazon or Facebook to mediate transactions between you and me, it can all happen on a decentralized network of computers protected by cryptography, and we pay for that execution using Ether. And this is just one of many snapshots you'll see of all the different software applications and all the different categories that could be programmed on Solidity on the Ethereum blockchain. So many, many more that we can get to here, but I will leave this for you and you can go ahead and explore it. Drilling down in a little bit more detail, what exactly is a smart contract and what do I mean by DeFi? DeFi stands for decentralized finance. Imagine that you and I, so here let's say I'm the maker and you're the taker. Imagine we want to engage in some kind of transaction. So not just me sending you an Ether, but let's say I want to lend you one Ether in exchange for, let's say, 1,000 DAI as collateral, or vice versa, or any number of transactions. And that transaction gets done on a smart contract with code that you and I can see that's entirely open source. And it gets executed on the blockchain and added into the next block the same way that, say, me sending you one Bitcoin would be. So that's what that smart contract that gets entered there, and then it gets placed into something called an order book. Now, the terms here, maker, taker, and order book, imply that this smart contract implied in this picture is from what's called a DEX. A DEX is a decentralized exchange. So unlike a Coinbase or a Binance, it's a place where, say, you can exchange your Ether for DAI without going through a middleman, but entirely on the blockchain, on a decentralized order book. Here I've gotten this picture from a link that you can see below, but if you ever try to do one of these DEX fees, you'll notice there is a transaction cost, and that transaction cost can sometimes be quite a bit higher than going through a decentralized exchange. That's what's called the gas fee, and that is why you are hearing so much about Ethereum's transition from proof of work to proof of stake. As I mentioned earlier, proof of work involves lots of computing power, and that computing power gets more and more expensive the more computers are competing to mine blocks. Now, one thing that's different between Ether and Bitcoin is, unlike Bitcoin, Ether's supply is not absolutely fixed. Now, you may have heard that there was a big update recently that that basically turned Ether from being an inflationary currency to possibly even a deflationary currency for the foreseeable future. That's what you see in the supply chart here. But Ether has gone through several different forks and updates and upgrades. And arguably, the whole idea of the Ether ecosystem is to make sure there are enough tokens there to pay for transactions in that whole DeFi ecosystem. That is much more important than just having a fixed supply, like a fixed supply of gold that we can transfer back and forth. So many sources you can look at to see how the number of Ether is evolving over time, but that is one very important difference to keep in mind. Now, talking about upgrades, there are many sources that you can look at for this, but one good one to start with is the Ethereum website itself. So here is one screenshot from part of the website ethereum.org, the section that has to do with upgrades. And a few of the upgrades that you might want to read more about. Number one is the one called the Beacon chain. The second one, which is expected a little bit later this year, is called the Merge. That's the one where the proof of stake Ethereum 2.0 is expected to merge with the main Ether network that we all know and love so far. And then later on in 2023, Ethereum is expected to support something called sharding, which you can currently see on Cardano. Basically, what sharding is meant to do is to break up transactions in a way that they can be processed far more efficiently. And the sum of all three things on this page really is to show that the goal of these Ethereum upgrades is to reduce transaction costs. So that if I want to, for example, go to Aave and do some lending, I don't want my transaction cost or my gas fee to make the cost of that transaction prohibitively high. So reducing that cost, mainly by taking out mining, by not requiring proof of work, but rather using another system called proof of stake, is hopefully going to make that far more effective and allow us to use the ecosystem more widely. Just a quick summary, what is the difference between proof of work and proof of stake? So as I mentioned earlier, with proof of work, computers around the world are all racing to guess what that number is that they need to add to the end of the block in order to have the signature begin with a certain number of zeros. So that's what's called the proof of work, is that in order to generate that signature, you need to put in enough computing power to guess that number. And maybe you can get really lucky, but really what you're proving there is that you have the computing power to back up guessing trillions and trillions of numbers in very quick succession. And the way that it works is that it's so competitive that unless anyone has over 51% of all the computing power on the network, it's going to be a different computer confirming transactions over time, and then the longest chain will be the result of many different computers, each adding one block at a time. That's different from proof of stake, where in proof of stake, I don't need to burn lots and lots of computing power to guess a number. Instead, the network will pick one of the nodes, will pick a computer to forge a block, really based on chance, based on them placing a certain stake onto the network. So for Ethereum, the planned required stake is 32 Ether staked on the network in order to basically be able to forge a block. And nodes, computers that are attached to the network, will be selected based on that stake. As you can guess, that requires a lot less energy to do. Still will prevent fraudulent transactions, because in order to create fraudulent transactions, you're going to need to put up a lot of Ether. Arguably, you'll need to have 51% of all Ether in order to maintain a fraudulent block. And because of that, transaction costs are expected to be much, much lower. Now, whatever those transaction costs are going to be, those are expected to be paid out in what are called mining rewards. I'm sorry, not mining rewards, staking rewards. So later on, when we talk about what is the interest rate in Ether, if you have Ether and you are staking it and you are earning, say, a 1% a year, 12% a year staking reward, that is a value in holding Ether that you're not going to get from holding Bitcoin, because just by holding Bitcoin, you do not get any staking rewards. That's something that'll be quite important to consider for any long-term holding. So now let's move on to prices before we talk about futures and futures trading. This chart only goes back to around 2015, but it shows you that both Bitcoin and Ether are highly, highly correlated. Now keep in mind, these are logarithmic charts, and they're meant to show you how these two move up and down in percentage terms. But I took this snapshot on June 28th, and it's meant to show you that really, yes, they move up and down together. Yes, the value of one Bitcoin coin is more than the value of one Ether, but it's not about the absolute numbers, it's about the two moving up and down. There are a number of reasons why you might explain this. There are a lot of people who are treating crypto as an asset class, and they're buying and selling them together. Although arguably the Ethereum ecosystem is quite different than the Bitcoin ecosystem in how they're developing. That said, here are the two prices as you see them. So as I said earlier, when we look at Bitcoin, the main thing about Bitcoin, it is the first and really purest implementation of a proof of work blockchain. It really doesn't even try to do anything else as far as smart contracts or efficiency and so on like that. It really just emphasizes that level of purity. Now, there have been some forks. When I talk about there only ever being 21 million Bitcoin, the main competitor to Bitcoin arguably are other cryptocurrencies and other blockchains which try to compete with it. Two that forked off of Bitcoin itself have tickers BCH and BSV, which are Bitcoin Cash and Bitcoin Satoshi's Vision. You can read about both of those, but those both arose out of arguments and differences on how big the block size should be, and the size of the block size has implications on things like transaction costs and the ability to be centralized versus decentralized. Very, very philosophical, and you get a lot of, I would say politically extreme views on this, but it's there if you want to read more about it. But bottom line, Bitcoin's value is based solely on the fact that it is scarce. And if you buy a Bitcoin, you are pretty much betting that someone else is going to be willing to pay you more for that Bitcoin later because you own one of only 21 million Bitcoins. In that way, I say it's comparable to gold. They're basically inert blocks that sit around and they don't do anything. It probably costs you some money to store it. You'll never earn any interest on it. And it's just basically traded around from place to place as a so-called store of value. I don't hold any gold. I really don't hold any significant amount of Bitcoin because I think it's a fairly foolish place to keep value. That's my opinion, but I've hopefully provided you enough information to make your own judgment on Bitcoin. Now, Ether, by contrast, really focused first and foremost on smart contracts, on the ability to execute code, to execute this decentralized software on a blockchain in a way that is immutable and no one can change it, and two parties who don't know or necessarily even trust each other can execute transactions using these smart contracts. Now, it started off as proof of work because that was the consensus mechanism that existed when Ethereum started, but it is transitioning to proof of stake. That is something which I believe is going to make transactions much less expensive over time. But I do suggest if you're interested in proof of stake, take a look at Cardano because Cardano has been doing it for longer already. And I think you're going to see Ethereum versus Cardano continue to work out who's going to rule the smart contract space. Now, in terms of fork, the biggest and most high-profile fork from Ethereum was something called Ethereum Classic. And this had to do with a single fraudulent transaction that the rest of the Ethereum network decided to reverse. And Ethereum Classic was arguing no, blockchain transactions should be immutable. And so Ethereum Classic was going to move on with a blockchain that did not recognize that reversal. That said, you can go ahead and read up on Ethereum Classic and that whole situation there. But the other thing really with Ether is that unlike Bitcoin, many of the tokens that you see, in fact, many of the ICOs that you saw many years ago were all built on Ethereum. In fact, if you hear something called an ERC20 token, an ERC20 token is a token that is designed on the Ethereum blockchain, uses Ethereum smart contracts in order to issue and redeem. The ultimate value of an Ether itself is really based on how much demand is there to execute smart contracts on Ethereum. And however do those miners or forgers on the Ethereum network need to get paid to execute those smart contracts. That's why I say that it's a lot more like oil. So in other words, if you want to ride the bus, you're going to need to pay for the fuel for that bus to drive you somewhere. And so if a lot of people want to drive the bus and that pushes, fuel prices up, it's going to cost a lot more to drive the bus than if nobody wants to drive the bus. Maybe not the best analogy, but I think what you see what I mean there. So that's what I mean when I say, unlike Bitcoin being like gold, Ether is a lot more like oil or gas. It's basically a fuel used to run a smart contract ecosystem. In other ways, I also say it's like a fiat currency, in the sense that why is there value for US dollars? There's value for US dollars because people want to be involved in the US economy. The US government will always accept US dollars for US taxes. So long as there are people who need to pay US taxes because they're in the US economy, there will be demand for dollars to pay those taxes. So many different ways you can look at it, but that's my economic view. So that's the fundamentals. Got a few minutes left. Let's talk about futures and what I called that free money trade that you should be paying attention to. Now, first of all, any of you who are new to futures, now I'm guessing those of you here have Phillip's futures account, so maybe you're not entirely new. This is review. I just want to give you a sample of what a micro Bitcoin futures trade would look like in your futures account. So let's say, for example, you have $2,000 of margin in your futures account, and then you sell one micro Bitcoin futures contract. Now, as I'll repeat a few times, one micro Bitcoin futures is worth 0.1 Bitcoin, 0.1 Bitcoin. And let's say you sell it at a price of $22,000 per Bitcoin. Now, the nice thing about a futures contract, you don't need to own anything in your account other than that margin. You don't need to borrow anything or sell it short. But this is one way for you to get exposure to the price of Bitcoin going down. Now, let's say, for example, you sell this contract at 22,000, and next thing you know, the price of Bitcoin goes up to 27,000. So if you've sold this contract, then you lose money when the price of the futures contract goes up. And since it's 0.1 Bitcoin, if it goes up by $5,000, you lose $500 on a mark-to-market basis. That means $500 will be taken out of your account, and your margin balance will go from $2,000 to $1,500. Now, that's not a problem really, because the maintenance margin requirement for this contract is about $670. So you're still well above that. You're not going to get a margin call. But the exact opposite would happen if you were long the contract. If you think Bitcoin is going to go up, you would buy one contract. And if you think Bitcoin is going to go down, you sell one contract. So this is what happens if Bitcoin goes up to 27,000. Then let's say right after that, Bitcoin price goes from 27,000 down to 17,000. That's a difference of $10,000 per Bitcoin times 0.1. It means that you are now $1,000 ahead of where you were yesterday. Now, all of these settlements happen on a daily basis, but if you are still short that one contract from 27,000 down to 17,000, an extra $1,000 gets settled into your account, and your margin balance goes up to $2,500. Woohoo! So that's really, in a nutshell, how future settlement works. This is the one slide I've been using for anyone who's new to futures trading. If you're new to futures trading, make sure you understand this slide. If you're not, then hopefully this is a good review. Now let's move on to Bitcoin micro futures specifically. So here is the page specifically from the CME website, where you can see just one snapshot on a given day. What were the prices of different micro Bitcoin futures expiring in different months? Now, one thing to keep in mind for Bitcoin futures, when you buy or sell them, you are not buying or selling Bitcoin. Rather, you are buying a contract to settle into the Bitcoin price on some future date. So you'll see here, there is a July contract, an August contract, and a September contract. And what I'm highlighting here is that at a given time, and here I'm looking at the settle column, which is the one that actually settles the price to and from your account, you'll notice that the price of the September contract is higher than the price of the July contract. This is what is called contango, meaning that later month futures are trading at a higher price than near month futures. This means that if you buy every single month and then roll out of them, so as you approach July expiry, you sell out of July, and by August, you sell out of August, and by September, you're going to have to pay higher and higher prices for every single futures contract, and that's going to cost you money. The opposite of contango is backwardation. You sometimes see backwardation when later months are trading at cheaper and cheaper prices, and you may see that with Bitcoin at different times. I'll try my best to explain in later slides what contango means and why I see a particular trading opportunity there. Now, one driver of contango, in my opinion, I could be wrong, but I believe has a lot to do with the launch of futures-based exchange-traded products. So futures-based ETFs and ETNs that try to track Bitcoin not directly, but using futures. What this means is that you have institutions that have to buy Bitcoin futures contracts. So in other words, they can't buy physical Bitcoin, they can't get Bitcoin in other ways. They have to use regulated, CME Bitcoin futures. And to do that, it means that there's a lot more buyers than sellers, and the sellers are able to get a slightly higher price than they otherwise would. This chart shows you how the assets under management of one particular US listed Bitcoin ETF, which uses futures, has outpaced the price, which means that basically money has continued flowing into it even when the price of Bitcoin goes down. This is money that has to buy CME Bitcoin futures whether they want to or not. And that's why I think it presents you an opportunity. What does contango mean, and how can you back it out and see whether there's an arbitrage opportunity? Well, let's say, for example, I'm going to take those two numbers that I showed you. Let's say the front month contract is $20,800, and I think I might have had a slightly off number here, and let's say the third month contract is $20,852. So you've basically got two different exchanges you can do. So in July, you can exchange one Bitcoin for 20,800, and you can lock that in with the July futures. And then the September futures, you can lock in an exchange rate of 21,910. Now, how do I match those two? Well, I know that if I take $20,800 and I put it in the bank, put it in, say, a 2-month bank deposit, I can get 1.5% interest, either from the bank deposit or T-bills or so on. So the market rate for $20,800 in 2 months is $20,852. Now, to make these prices match, to make July 20,800 match September 21,900, that means my $20,852 in September only corresponds to 0.9972 Bitcoin. What that means is that the implied interest rate on Bitcoin, to the extent that Bitcoin has an interest rate, is actually negative in this case. Not just a little negative, it's negative about 1.5%. So what does that mean? There's a lot of ways of interpreting it. But one thing is Bitcoin, of course, does not get any staking rewards. Bitcoin, arguably, in fact, there's a market for people who want to borrow it to sell it short. And if you're in a position right now to, let's say, hold a Bitcoin and you don't have to pay that price, and you can sell the Bitcoin futures forward, if you can sell the September, you can make this higher interest rate than the one that you see here. Just as a quick aside, and again, I know I'm mixing Bitcoin and Ether a little bit here. If you look at the micro Ether futures, you'll notice the exact same pattern here. Now, micro Ether futures are also 0.1 per contract. You'll also see that the September is trading at a premium to July. You can plug these same numbers into the slide like we have earlier and see that the implied interest rate on Ether is effectively negative. So as I mentioned earlier, what do these implied rates mean? Directly, what it means is that the market is paying a premium to hold, to go long, or even lever up these crypto futures. So what it means is if you want to short crypto, you'll get a better price, a better deal by selling futures than you will by trying to borrow crypto and sell them using DEXs. Now, indirectly, what it means is that, let's say, for example, if you have Ether and you, let's say, lend it out, the returns are effectively negative. This means that whoever is shorting these, not on the futures market, but in the DEXs, are effectively paying to borrow these assets and pay them and sell them short. This goes against, like I said, the expectation that in the future, Ether should actually be paying positive staking rewards. So That's what I mean altogether when I say that there's an arbitrage. Now, by comparison, imagine that you were looking at the US dollar versus the Swiss franc. The Swiss franc actually does have a negative interest rate. If you do keep 1,000,000 Swiss francs in a bank in Switzerland, you will be charged for it. That is not the case with Bitcoin or Ether, where if you just keep them in your wallet, no smart contract is going to charge you or slash your stake just for it being there. So for now, don't be surprised that there are inefficiencies. And that's why I say don't be too surprised that there's a bit of free money here on the table, even though it's not a heck of a lot. Now, as I mentioned, in theory, these futures contracts imply that the lending rate on Ether should be negative. But when I look on Aave, so here on Aave, I've got a little bit of Ether and a little bit of USDC. It shows for both of these, the interest rate I could earn on them is positive. Not huge, about 0.5%, but positive. So clearly, if I have Ether and I lend it on Aave, and then I sell those micro Ether futures forward, I am going to lock in an above market rate of interest. So I'm gonna enjoy that. So sample trade. Here I've used the example of Bitcoin, although I could use micro Ether just as easily. The exact trade I'm suggesting here is you go long 0.1 Bitcoin at 20,900, and then you sell the September, so MBTU, U stands for September, 2 is 2022, you sell one micro contract at 21,150. The implied carry, now if you do the difference between these two, you've guaranteed that you've bought the Bitcoin at 20,900, and the futures are going to guarantee that in September you can sell it at 21,150. On an annualized basis, that's 4.78 per annum, which is really, really good if you could call it effectively a CME guaranteed rate of return. That's what I mean by free money. If you can borrow money at 1.5% and lend it at 4.78, that's as good as a guaranteed rate of return as you're likely to get. You can ask, why on earth isn't every bank who can borrow money at 1.5% doing it? Most banks can't. They're too regulated that they can't just do these carry trades. Now, if you are actually holding this Bitcoin and you've sold the September futures, when the September futures comes to expiry, you don't necessarily have to close your Bitcoin position. You can simply sell out of the September and then, let's say, sell a December contract at that point. And then come December, you can close out the December and sell a March contract. So you can keep this going as long as the futures remain in contango. So like I say, I'm presenting this as an example because it's a simple trade. Let's keep doing this until this contango goes away. The nice thing about this trade that I'm presenting is that there is no exposure to the price of Bitcoin going up or down. So imagine you put this trade on and Bitcoin goes to 10,000 or up to 30,000. Well, the value of your Bitcoin will go up or down, but the value of your short futures contract will go in exactly the opposite direction. All you are doing is you are capturing that difference between 20,900 and 21,150. That's all you're doing here. So what are the risks to this trade? I presented what seemed almost like a risk-free arbitrage profit. Is there any risk? Well, yes, of course. The first most obvious risk is don't lose your keys. If you buy 0.1 Bitcoin and keep them on your Trezor or your Ledger, you need to make sure that you don't lose your keys and you don't burn it all in transaction fees. There also is, of course, a little bit of basis risk. You are presumably holding physical Bitcoin, and at some point you're going to need to trade out of it. But the price at which you trade out of it may not be the same price as what the BRCME CF Bitcoin reference rate will be that the futures contract tracks. That is what is called basis risk, the difference between the price at which you trade in the physical market versus the cash settled price of the futures. Make sure you understand that difference before you put on any such trade. Also keep in mind that the contango that we talked about could easily flip to backwardation. So right now you can effectively earn this 4.78% by buying Bitcoin and selling MBTU. But imagine, let's say next year, the whole trade could be in reverse, where Bitcoin futures trade at a deep discount to Bitcoin spot. And in that case, this trade no longer makes sense. You're going to need to get out of it, and you may or may not be able to exit in the physical market on such favorable terms. So yes, there's risk, but overall, I think if you look into it, in my opinion, the risk is relatively low. So that was my presentation. I think I try to keep it, exactly on an hour spot. At this time, I'd like to pass it back to Minghui and open the floor to any questions that there might be.
All right, thanks, Tariq. We're now moving on to our Q&A session, so do send in your questions, everyone. We currently don't have any questions, so Tariq, if there's anything else you'd like to share, we can do that while we wait for the questions to roll in.
Sure. Yep. So here I've just provided my contact information in case you'd like to ask me any questions or see or read more of what I do. Of all these sites, the one I'm probably most active on is Seeking Alpha. So if you're on Seeking Alpha, you can look me up there and you can read mostly what I write about stocks, a little bit about crypto. I've also gotten a little bit back more on Twitter, although I probably will be needing to change my Twitter handle soon. And yeah, there I am.
Okay, thanks, Tariq. I don't think we have any questions coming in from our audience tonight, and since time is almost up as well, so I think we can conclude our webinar here.
Thank you.
Yep,
Thank you, Minghui.
all
It's
right.
been a pleasure presenting. I hope to all of you who've made time out of your evening to attend this that you've learned something new and been inspired to learn a lot more about the crypto system.
All right, thank you. Yeah, so to our audience, if you have any further questions for Tariq, you can send them to us via the survey that will appear at the end of the webinar, and we will get back to you via email. And yeah, this was a very insightful session. So thank you again, Tariq, and thank you very much, everybody, for your time tuning into this webinar tonight. We will be sending everyone a link to today's webinar recording so you can watch it again if you'd like to. And that's all for today. Thank you, everyone, and goodbye.
Thank you. Have a good night.